If the idea of putting your money into an investment that you cannot immediately access makes you uncomfortable, you're not alone. That instinct to stay liquid, to keep your options open, to never feel locked in, it is one of the most common hesitations investors have. But here's the question worth sitting with. Is staying liquid actually serving your goals? Or is it just making you feel better in the short term? Because liquidity and cash flow are not the same thing. One is about access, the other is about income. And depending on where you are in your financial life, one of them matters far more than the other. One thing before we jump in, I'm Blake Wiswell, and what you're seeing is an AI avatar of me. Beyond the Ticker runs on real expertise delivered in a modern way. Now let's get into it. Liquidity is not complicated. Stocks settle in one day, ETFs the same. A savings account is liquid, a money market fund is liquid. For most investors, access to capital is generally available. The real question is whether staying liquid is actually serving your goals, or just making you feel better in the short term. Because liquidity comes with a trade-off. The more you prioritize access, the more you may be sacrificing growth, income, or both. And if your principal is not large enough to generate the income you need while also remaining fully accessible, then insisting on liquidity may be the thing standing between you and your goal. That is worth being honest with yourself about before you build a retirement strategy around it. When it comes to retirement, the question sharpens into something very practical. Do you need liquidity or do you need cash flow? A liquid portfolio gives you access to capital. An income-generating portfolio gives you a recurring stream of usable money. Both can fund a retirement, but they work differently and they fail differently. Take the most liquid end of the investing spectrum. Cash, money market funds, short-term treasuries. You can access every dollar almost immediately. But what is that accessibility costing you? In most environments, these instruments are barely keeping pace with inflation, if they are keeping pace at all. You're not growing your money, you're preserving access to it. That trade-off makes sense for an emergency fund or short-term need, but as a retirement strategy, it quickly erodes your purchasing power over time while your principal sits idle. Move slightly up the risk spectrum to a broadly diversified ETF portfolio. More growth potential, but now you are dependent on the market cooperating when you need to create income. If you need cash, you sell shares. If the market is down when you need to sell, you lock in losses and shrink the base that would have otherwise recovered. The liquidity is there, but it is not generating income on its own, and accessing it introduces timing risk that most investors do not fully account for until it is too late. On the other end of the spectrum, consider an investor in a fixed annuity paying a guaranteed income stream for life. The cash flow problem is solved. Every month, the income arrives regardless of what markets are doing. But that investor may have surrendered access to their principal entirely in exchange for that income. The lifestyle is funded, but there is nothing left to absorb an unexpected expense. The income is there, the liquidity is not. Both of these investors made reasonable decisions. Neither has a complete strategy, though. And both had to answer the same honest question first. Do I have enough principal to be both liquid and income generating at the same time? If the answer is yes, the strategy looks one way. If the answer is no, it looks very different. Account structure matters here too. If you have spent years maxing out your 401k, that discipline is smart. But if you want to retire before age 59 and a half, that money is not truly liquid without a 10% early withdrawal penalty on top of the ordinary income taxes you would be paying. The capital exists, but accessing it on your timeline comes at a cost. Building an entire retirement plan around tax-deferred accounts without considering when you can actually access them is one of the most common gaps we see in otherwise well-intentioned strategies. Start with two questions. How much do I need my money to generate monthly to fund my lifestyle? And how much do I need accessible if something unexpected happens? Those are your cash flow numbers and your liquidity numbers. They are almost never the same. The gap between them and whether your principal can cover both is an honest measure of where your retirement strategy actually stands. The goal is not maximum liquidity. It is not maximum income. It is the right balance of both for your situation. Every product and every account type we have covered on this channel comes with its own answer to those two questions. Understanding where each one sits is how you build something that actually works. Remember, knowledge is the one investment that never loses value, and and that is exactly what Beyond the Ticker is built on. If you got something out of this, like the video, subscribe, and pass it along to someone who would appreciate it. Every share helps us reach more people, and we are grateful for every single one. See you next time.